Hello everyone, and welcome to another episode of this video blog with the Rafael del Pino Foundation, in which today we're going to be talking about negative interest rates. What is this that we're talking about constantly about negative interest rates? What are negative interest rates? Let's talk first about what interest rates themselves are. Interest rates are the remuneration for the risk of lending capital. Imagine that you're going to lend some money to somebody, to a close friend or somebody from the family. You may decide to lend the money at no cost, hoping that that person is going to give it back to you sometime in the future. Imagine that instead of doing it once, your business, your activity is to lend money to everyone and people that you actually don't know at all, have never met. Therefore, the logic dictates that you, when you lend, will receive some compensation for the risk of the project that is going to be financed fails, for many other risks, and obviously for the risk of not being repaid, because there will be a percentage of loans that you will not receive back, and there will be some that you will have to refinance, etc. Interest rates therefore compensate for the risk and compensate for the differences of repayment capacity of each of the borrowers. So maybe a large company with high cash flows borrows some money, that company is going to receive a lower rate than a struggling firm that is having tremendous difficulties to finance itself and to even sell some assets or regain foothold of its business. Obviously, there has to be a different price for money. That is what interest rates are, the price of money. Now, let's understand then, how have we arrived to a level in which we have negative interest rates? Central planners, central banks, what they do usually is work with two tools. One is lowering or raising interest rates according to the movements in inflation, in unemployment, and growth, etc. Second is liquidity, is providing liquidity to the market in order for the motor of the economy, which is what we were talking about before: lending, borrowing, investing, repaying it back, and getting back into a growth mode and returning more to the economy than the cost of capital, etc., etc. So what central banks do is that they analyze the economy and they see, for example, a slowdown in investment, a slowdown in growth of consumption, and they always believe that it is a problem of demand. They always think that interest rates have to be lowered in order to incentivize demand. However, that is not always the case. And in many cases, the reason why central banks lower rates are not even because they see a slowdown in credit growth, like we are seeing right now in the United States, where there is none, or that they're seeing a big slowdown in consumption or in growth or an increase in unemployment. The reason why they do it is preemptive, is because other central banks are actually lowering rates. No? So when they lower rates, but the diagnosis of the economy that they have, which is that it's a problem of demand and that demand has to be incentivized, doesn't happen. What happens is that you create very large bubbles in financial assets. And therefore, what you end up creating almost a downward spiral. First, because the assumption that credit growth, investment growth, and consumption, those are not growing, first, might be wrong. Second, it's always based on what they expect it to grow. Not necessarily that it is not growing, but that they expect it to grow more. And then, if it doesn't happen, they blame interest rates or liquidity. So, a tremendous amount of that liquidity goes, in fact, not to taking more risk, but goes to the safest asset, to sovereign bonds. And sovereign bond yields start to fall, and they get to the levels where we're seeing right now, negative levels, in which there's almost a cat and mouse chase between interest rates, lowering interest rates, increasing liquidity, and at the same time lowering yields and the economy slowing down further. In reality, the lowering interest rates to the level that they are, for example, in the Eurozone at negative levels, that is in itself a subsidy to obsolescence and to excess. It is a transfer of wealth from the savers and from the efficient to the indebted and the inefficient. And there is a growing school of people advising central banks and governments that say that the reason why negative rates are not working is because we, you and I, believe that those rates are going to rise sometime in the future. And therefore, what they have to do is to continue lowering rates even to further negative levels until, and I quote, investors capitulate and they decide to take more risk, invest more, and demand more credit. However, again, it is a problem of diagnosis. Central banks are looking at the world from the perspective of what they expect the economy to invest and they expect the economy to consume, and it is not happening, but not because there is no inflation. Let's start from that premise. In the Eurozone, for example, we hear that there is no inflation. There is no inflation whatsoever, yet every day in Paris, in Italy, in Germany, in Spain, you have demonstrations all over the countries of people demanding solutions to the rising cost of living. And it's not a coincidence that central banks believe on one side that there is no inflation, and at the same time you have people demanding, making demonstrations against the rising cost of living. It's because non-tradable goods are rising much faster than salaries, than wages, than disposable income, while tradable goods, holidays, technology, etc., those are falling rapidly. Therefore, the average on CPI, in the basket of goods and services, doesn't look high. However, for many people, the cost of living is rising much faster than the salaries, definitely than the disposable income that they earn. So that in itself is creating precisely that consumption growth is not as high. That economic growth is also not that high because as you lower interest rates further and further and further, what you're doing is incentivize malinvestment, perpetuate overcapacity. Zombie firms, those that cannot refinance themselves, that cannot pay their interest expense with operating profits, zombie firms are rising all over the world because banks consistently refinance them, no? So what we end up doing is we are creating a perverse incentive. The central banks themselves are becoming enablers and hostages of their own policy. They're enablers of the bubbles. Why do you not raise interest rates when every single country in the Eurozone is financing themselves at negative rates on a 2-year maturity? Why not do it? No? You don't do it because you fear that asset prices could collapse. And if asset prices collapse, that could lead to an effect in the real economy. But then you lower interest rates, you may keep financial assets higher, but you become the enabler of financial bubbles. At such point, that what happens ultimately is that the very weak return of monetary policy and the even weaker return of fiscal policies, because deficit spending in leveraged economies and open economies becomes negative in its multiplier of the economy, as we have seen in so many papers. If we look at that, what ends up happening is that you're basically incentivizing low productivity, subsidizing the obsolescence, refinancing zombie firms, and perpetuating overcapacity. With those factors, you become it becomes almost impossible to normalize monetary policy. And instead of leading economic agents to take more risk, what economic agents do, and rightly so, is be more prudent. Therefore, investment growth is lower, consumption growth is lower, etc. It's lower than what the central banks expect. Again, coming back to the point. And another twist in interest rates, another increase in liquidity, generates even weaker results. So when we look at the world right now, what we need to understand is that at some point, governments will have to understand that more aggressive fiscal policies and more aggressive monetary policies are not going to deliver the results that they intend to achieve, because we have exhausted all those tools. That what they need to do is to go back to sanity and come back to what really works, which is to let the economic agents breathe, let the creative destruction to get rid of obsolescent sectors so that the thriving high productivity sectors improve and change the economic pattern. Productivity growth improves, and with it wages and salaries, etc. We need supply measures in which we let disposable income rise so that families can consume more, instead of giving more to governments that increase dramatically deficit spending on current spending. All of those factors, instead of becoming an incentive to malinvestment, debt and overcapacity, so that they become an incentive on prudent investment, saving and productive growth. And that is, at the end of the day, the solution. Unfortunately, we will likely go further into negative interest rate territory. We might even decide to give money to people and helicopter money, which will be atrocious in the midterm, as well, as we said in one of the episodes. But ultimately, the solution can only come from supply side measures.